All right, in this section, what we're going to do is we're going to extend the capital asset pricing model. We've derived the CAPM graphically. We've worked a bunch of examples. We've estimated the CAPM for Microsoft and Facebook. We've talked about the relevance of the CAPM to industry. Firms are using the CAPM all the time. And we've also talked about where the CAPM fits, the implications of the CAPM with respect to optimal portfolios or the optimization of portfolios. Okay. So in other words, the CAPM matters. It's a decent model. It's not perfect by any means, but it's a decent model that is widely used in industry. Let's go ahead and extend that. Now keep in mind here, we must try to account for all types of systematic risk. Okay, so the capital asset pricing model is telling us that beta, right? If I, in fact, let me what I'm going to do here. Let me just delete or hide this for a second. Here's your CAPM. And this beta is measuring a firm's exposure to systematic risk. And how do we measure systematic risk? In a previous video, we talked about this. This coronavirus pandemic is a perfect example of a systematic risk event. Okay. And how do we measure a systematic risk event? Well, let's look and see what investors think of that systematic risk event. So we're going to look at the expected return on the market minus the risk-free rate. Okay, this is called the market risk premium. And we're going to see how investors have priced in that risk. Okay, and beta is going to give us exposure or going to tell us the exposure that a particular firm has to that level of systematic risk. Now let's extend it. So it's not perfect, right? We're approximating what we think systematic risk is. All right. Let me highlight something here. So what we're going to do, we're going to extend CAPM by including two other additional risk factors, which I'll explain. The first risk factor is called SMB. This stands for small minus big, or small cap stocks minus large cap stocks. I'll explain exactly how this factor is estimated. And the second additional factor is called HML. This is high minus low, or high book to market ratios minus low book to market ratios. Okay, and let me explain what this is. So here's an interesting graph. I don't know if I showed you this or not, but this will be kind of interesting here. So this is, I don't have the most up-to-date data here, but you can see from 1925 to 2007, basically it measures how much your investment would be worth if you put $1 into, the blue line represents the S&P 500 or the 500 largest stocks, what that dollar would be worth if you invested in 1925, what it would be worth in 2007. Likewise, if you invested $1 in the smallest cap stocks, the purple line, what would that $1 investment be worth in 2007? And you can see that small cap stocks have outperformed largely the large cap stocks, right? There's been a great deal of outperformance, particularly in the latter half of the 1900s. Okay, so this is interesting, right? If I were to take the average rate of return for large cap stocks during this time period, it's about 12%, a little bit over 12%. If I were to take the average return for small cap stocks, it's about 17.5%. So in other words, buying a portfolio of small cap stocks, you're going to outperform the S&P 500 by about 4%. Okay, almost 5%. Okay, so that's important to understand, that small cap stocks have outperformed large cap stocks. Now I want you to notice something else here. So you can see that the standard deviation, or the volatility, or the price movements of the purple line are deeper and greater and more extreme than the price movements of the blue line. Notice also that the price movements of the blue line, the volatility of the blue line, is greater than the volatility of the black line, which is long-term government bonds, which, by the way, I think during this time period, long-term government bonds were paying about 5% per year on average. Okay, so this idea suggests that small cap stocks are somehow riskier than large cap stocks, and this might be explained in the following way. It could be explained that small cap stocks are riskier than large cap stocks because small cap stocks are growth firms, right? They're trying to break into a particular industry, right? They have to take extreme risks to do that. They're going to take on more debt. right, than larger firms, and therefore they might face more bankruptcy. So there's a whole variety of reasons why small cap stocks might be riskier than large cap stocks. All right. We don't know the exact explanation for why that is, but what we're going to do, we're going to just create a factor where we're going to allow the market to tell us or to price in the risks of small cap stocks versus large cap stocks. This SMB factor, this SMB factor is calculated in the following way. Every month, okay, every month, the universe of stocks that are traded in the United States on major stock exchanges is sorted into 10 portfolios based on market cap. And you have the largest cap portfolios, stocks in portfolio 10, the largest cap portfolios, and stocks in portfolio 1 are small cap stocks. And then how this factor is formed is they take Eugene Fama and Ken French. This is what the model is named after. They take the returns to the small cap stocks and they subtract the returns from the large cap stocks. Does that make sense? So the returns on small cap stocks minus the returns on large cap stocks is going to give us our risk factor called SMB, right? And if I go back here, notice that there have been years where the difference between small cap stock performance and large cap stock performance was high. Look here, in 1985, it looks like it was the highest. Notice that it was getting higher prior to the financial crisis. Notice that it wasn't. In fact, it was negative in the 1950s. Right? Small cap stocks were not outperforming large cap stocks. That's true also in the early 40s and late 30s. So there have been instances where small cap stocks have underperformed large cap stocks and instances where small cap stocks have outperformed large cap stocks. Again, we're assuming that small cap stocks are riskier than large cap stocks, and so what we're doing is we're taking the market's word for this, okay? We're letting the market price these stocks relative to large cap stocks and tell us how much of a risk that is. Does that make sense? Okay. So this idea is also used to calculate. The second new risk factor, HML. So it's been shown historically that high book to market ratios outperform low book to market ratios. All right. You can think of this pretty straightforwardly. So the market value is determined by the market. The book value is determined by what's on the financial statements. And the market is probably pricing what's on the financial statements accordingly, right? However, there might be instances where the book value is relatively high to the market value for some stocks, and there might be other stocks where the book value is relatively low. Let me show you an example here. If I go to Netflix, Netflix is an interesting company. Some of you remember back in the day when Netflix first started, you basically order DVDs and they would mail them to you, and then you'd have to mail them back when they were due. All right. Now Netflix is not only a streaming service, but Netflix also they're making new movies all the time, and Netflix has done well. They've been very innovative. And notice something here. We have the PE ratio. This is the price determined by the market, the price per share relative to the net income or the earnings per share. And notice that Netflix has a PE ratio of 86.52, suggesting that the market has bid up what is on the books, the earnings on the books. Does that make sense? For every dollar of earnings, Netflix is priced at $86. Let's look at Apple. So Apple has also been a fairly innovative company, but notice something, that Apple's PE ratio is much lower. That is, the market has bid up Apple's stock at a lower rate relative to earnings than investors of Netflix have bid up Netflix stock. Does that? I hope I'm making sense here. I think this is important. So the idea here is that high book to market ratios. We're looking here at a market to book ratio, but high book to market ratios or low PE stocks will typically outperform high PE stocks. We assume that is just because they're riskier, right? There's this relationship between risk and return, and we assume that they're riskier, that high PE stocks are less risky than low PE stocks, and that explains why low PE stocks outperform. Or in the context of the Fama French three-factor model, that might explain why high book-to-market stocks outperform low book-to-market stocks. So what we do is we sort the universe of stocks into portfolios. Okay, we sort the universe of stocks into 10 portfolios based on book-to-market ratios. Stocks with low book-to-market ratios are portfolio 1. Stocks with high book-to-market ratios are portfolio 10. We then take the returns of the high book-to-market ratio stocks, portfolio 10, minus the returns to the low book-to-market ratio stocks. And this gives us another risk factor. Stocks with high book-to-market ratios outperform low book-to-market ratios. That's got to be explained by risk somehow. Okay? And we don't care about the explanations for that risk. All we care about is how the markets perceive that risk. And if the market has high book-to-market ratio stocks outperform low book-to-market ratio stocks, then the market is accounting for that risk. Okay, so the Fama French three-factor model is made up of the following factors. The first is the market risk premium. The second is the SMB, small minus big risk factor, and the third is the high minus low risk factor. Notice that each firm is going to have some sort of exposure to each of these risk factors, and also notice that none of these risk factors have the subscript I. Does that make sense? So the expected return for firm I is a function of systematic market-wide risk factors. Okay? That is, HML is not different for Apple than it is for Microsoft. However, the exposure of Apple to HML might be different than the exposure of HML for Microsoft. Okay, so notice that these risk factors are the same for each asset. All three of these risk factors are the same for each asset. And notice that those risk factors are trying to account for all of the the systematic risk that exists in the market.